Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hi everyone, this is Yazad. The last 2 years have been a rollercoaster ride for investors in the stock market. Despite such conditions, mid-cap stocks have performed better than large caps. Now, while the Nifty 50 gave a return of 81%, the Nifty Mid-Cap 100 gave a 126% return in the last 2 years. Now, this shows that mid-cap companies are a good investment option for investors in a bull run. Moreover, after the recent market correction, several mid-cap stocks are trading at attractive valuations. By investing in such undervalued companies, investors can gain from a high margin of safety. In today's video, let us look at 5 undervalued mid-cap stocks that you could add to your watch list. First up, we have the most undervalued mid-cap stock on our list, SHYAM METALIKS and Energy Limited, an integrated metal producing company. The company's current PE ratio stands at 8.6, while its price per book ratio stands at 2.3. It's trading at a much lower PE ratio than its peers, as the average PE of the steel industry is 16.1. SHYAM METALIKS primarily manufactures long steel products and ferroalloys. It is also present across the steel value chain by selling intermediate and final products. The company has a diversified product portfolio, including long steel products, ferroalloys, sponge iron pellets, structural products, and wire rods. It is one of the largest producers of ferroalloys in terms of installed capacity in India. It has 3 manufacturing facilities with a total installed metal capacity of 5.7 million tons per annum. The company plans to increase its installed capacity to 11.6 million tons per annum by 2025 through organic and inorganic growth. SHYAM METALIKS also has 8 captive power plants that generate electricity for its manufacturing plants, giving it a cost advantage. In the last 3 years, the company's revenue has grown at a compounded annual growth rate of 10.8%, driven by capacity addition. The net profit also grew by 9.8%. In the recent quarterly results, revenues grew by 51.7% year-on-year, and net profit jumped by 95% year-on-year. The company has also announced a capex of 9.9 billion rupees for 2022 and 2023, in line with its goal to double its capacity by 2025. Going forward, revenue growth in the medium term will be driven by capacity addition. The stock, which listed in June 2021, touched a high of 461 and a low of 288 rupees per share. Currently, it's trading at levels close to 300. Next on our list is India's leading gold loan non-banking finance company, Manappuram Finance. Its shares are currently trading at a PE of 6.2, much lower than the industry average of 26. Manappuram Finance is engaged in offering fund-based and fee-based services such as gold loans, microfinance, vehicle loans, and housing loans. It also ventured into the insurance broking business. It has a network of over 4,600 branches across the country and manages assets worth 272 billion rupees. In the last 3 years, the net interest income has grown at a CAGR of 13.2%, driven by higher disbursements. The net profit also grew at a CAGR of 22%, led by the lower lending cost. In recent quarterly results, the net interest income slightly declined by 12%. The net profit also fell by 46% due to higher provisioning. However, the consolidated assets under management grew 10% year-on-year. The company aims to increase its profits by reducing its operating costs and increasing its collection efficiency. The stock, which has fallen considerably from its 52-week high of 224 rupees and is currently trading close to its lows of the year. Third on our list is CESC, the flagship company of the RP Sanjeev Goenka Group. The stock's PE ratio currently stands at 13.2, while the price per book ratio is at just 1.07. CESC is engaged in the business of electricity generation and distribution to more than 3.3 million customers across Kolkata, Howrah, Rajasthan, Maharashtra and Noida. It's the sole power distribution licensee in Kolkata and Howrah with a validity up to 2038. The company has a 2,500 megawatt power generation capacity across 4 power plants. It also has a renewable power capacity of 174 megawatts across 4 wind plants and 1 solar plant. In the last 3 years, CESC's revenue has grown at a CAGR of 3.3%. The net profit also grew by 6.5%, driven by its cost-plus nature supporting profitability. In its latest quarterly results, revenues and net profit grew by 4.2% and 0.6% respectively. Going forward, increased adoption of digital payments and a diversified customer base will improve the company's collection efficiency, indicating stable cash flows. The stock has been relatively stable, trading in the range of 80 to 90 rupees per share over the last few months. Number 4 on our list is MAZAGON Shipbuilders, a leading shipbuilding yard in India. The shares are currently trading at a PE ratio of 8.5 and a price per book ratio of just 1.8. When compared to the average industry PE of 17.5, the shares of MAZAGON looks undervalued. Now, the company is engaged in the business of building and repairing ships, destroyers, warships, tankers and submarines for the Indian Navy and the Indian Coast Guard. It has a shipbuilding capacity of 4,000 deadweight tonnage and is expanding its capacity by building a new plant in Navi Mumbai. In the last 3 years, the revenue of MAZAGON declined slightly due to the pandemic. As a result, its net profit also declined, but the company managed to have a net margin of 11.2% in the last fiscal. In the recent quarterly results, the company's revenue grew by 6.3%. The net profit jumped 56.5% due to a strong order book. Going forward, the company is set to benefit from its strong order book and the government's push towards indigenization. After touching its 52-week high of 342 rupees last month, the stock has drifted lower and is currently trading at levels under 280 rupees. Interestingly, FIIs have increased their holdings from 1.8% to over 2% in the March 2022 quarter. Mutual funds have also increased holdings from 0.9% to 0.96% in the same period. Last on our list is MOTILAL OSWAL, a leading financial services provider. The company's shares are trading at a PE of 9.8, which is much lower than the average PE of 26% in the financial services industry. MOTILAL OSWAL started off as a broking unit and later ventured into asset management services, investment banking, private equity, margin financing, housing finance, and venture capital management. It has a network of over 2,500 business locations spread across 550 cities, serving over 1.6 million customers. In the last 3 years, the company's revenue has grown at a CAGR of over 12%. Net profit has also grown by a healthy CAGR of 61%, driven by growth in its broking business. In the recent quarterly results, revenues grew by 9.1%. However, net profit declined by 28% due to higher provisioning. Now, being among the top 10 brokers in India, the company witnessed robust growth due to higher investor participation in the market in the last few years. Going forward, with higher liquidity in the market, the company is expected to grow its broking business even further. In the last 12 months, the stock has made a high of 1,188 rupees and a low of 694 rupees. It currently trades at levels close to 880. Mid-cap stocks are under-researched stocks in the market. As a result, they are usually under-owned. Hence, they give its investors immense opportunity to unlock their value in the long term. However, they do come with a certain risk attached to them. Although they have high growth potential, these stocks are also more volatile than large caps. Now, if you are willing to take the risk and invest in sound mid-caps for the long term, there are high chances of earning promising returns. However, before investing in undervalued mid-caps, you must check the financials and fundamentals of each company. A little due diligence will guide you in choosing the right stock for your portfolio. With that, we come to the end of today's video. Thanks for watching, and if you like this video, please do share and like it. This is Yazad signing off. Happy investing. Goodbye.